clock is ticking, David. Navarro is kind of hawkish, so maybe there shouldn't be too much of a surprise in his comments, but it kind of does still throw a spanner in the works. How are you positioning yourself? You're still saying stay invested here.
Yes, actually, more than ever. And actually, it's a bit of a paradox, because if you have an extremely favorable outcome from the trade negotiation, the potential risk is that the Fed may actually decide to stop easing its policy and may go back at a certain point to a more hawkish stance. So in essence, and from a financial market performance point of view, something of a settlement or an agreement which wouldn't be 100% clear and settled probably wouldn't be a bad thing, because at the end of the day, you're still going to have all the central banks very much focused on making sure that those trade tensions don't derail the economies. And so from a financial point of view, it's not great to say that, but actually, you need still that liquidity to come in, and you don't want to see the best scenario to come out at this point.
The way I see it, though, yesterday and today, it's kind of like, at least in Asia, a little bit sideways. We're expecting this to happen in a sense. But what you are seeing, and I've got a chart on my terminal, is this very big volatility coming through in the yuan. And traders essentially are not taking any bets here, are they? So what do you see in terms of the currency moves?
Well, it's a very important point. In the outcome, we'd like to see actually a few words about the currency and the yuan policy, something like China committing to better stability, or the idea that it's going to be more the market forces which are going to be at play when it comes to actually fix the yuan positioning. That would be very positive from an investment point of view, because that would make foreign investors more comfortable in buying into domestic China assets. But nonetheless, at between 7 and 7.10, relative to the US dollar, but also to the rest of the currencies across the world, we think that the yuan is offering an interesting entry point at this level.
Okay, and then in terms of what we see with the tariff delay, as I said, sometimes it looks like it's priced in. But in terms of what we see after December 15, how do assets react here? This is our question of the day.
Well, the key point is that imagine early in the year you would say, okay, I'm not going to buy countries which are involved into trade tension. You wouldn't be invested in the US and in China, which are two of the best performing markets year to date. So the context right now, has it changed massively? No. At the end of the day, what matters is liquidity, is the central bank policy, it's the balance sheet expansion, which is taking place with the Fed, with the ECB, with the BOJ, potentially the PBOC at some point. And so that's why we say stay invested. And if there is any actually shortfall because of the outcome from the trade negotiation, it's probably more of a buy opportunity.
David, it's Rishi in Hong Kong. Great to see you. Do you think there's a problem with dollar liquidity?
Well, we know that some pockets are in the US. I mean, if you're talking about the US credit market overall and the access to US dollar in some part of the world, yes, there is some tension. We clearly see it in the high yield space, hard currency denominated. But the good news is that those segments are well identified. And we know we are at the end of a cycle. And at the end of the cycle, you see the weakest players, the weakest borrowers facing difficulties. So I would say that at this stage, there is no major surprise. And this is where investors overall should be actually focusing on quality. And actually, while maintaining quality, you are still able to generate superior yield and return. So talking about a shortage in US dollar access, yes, that's the case, but it doesn't, it's not so much difference from the previous cycle from that point of view. And again, the Fed is actually adding more liquidity every month, 60 billion US dollars, at least until April or May next year. So, at least over the next 6 months, we still have very decent visibility on that front.
But there are a lot of jitters. I'm going to go to China because we've got a lot of linkages between onshore and offshore bond markets there in China as well. And there are local defaults taking place. We haven't had a major blow up, but if there was one, how concerned would you be about that? And do you see that also playing into a 2020 story?
It's going to be actually, it's going to be meaningful. And we're going to see actually more and more default in the domestic market, bond market in China. The reason is that being the deleveraging actually process is still taking place. And really, there is a withdrawal of liquidity from some segment of the market. So that's definitely going to hurt. But I would say that just like this year, and 2019 was very much about active management. With a proper selective and active management, you are able to extract, the fundamental performance of the market, but on top of that, to add significant alpha. Next year is probably even more important because you're going to see actually more default, and so it's really going to be a case of selecting the right assets and, of course, avoid the very worst ones. And there's going to be more worst. But we don't see them actually, creating a systemic impact into the markets. And so overall, this is why the case still remains very much investable.